Welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. It's a brand new weekend, lots of cues to watch out for. It's an earnings heavyweight with the likes of Reliance Industries, Infosys, HUL, all of them reporting their first quarter numbers. So we will be keeping a tab on that. And of course, this morning, the GIFT Nifty is hinting at a start above that 19,600 mark. So we'll have to see whether or not we end up hitting fresh highs in today's session as well. And lots of stocks to watch out for, given the fact that HDFC Bank will be reporting its numbers. You've had numbers from Bandhan Bank, DMart, JustDial over the weekend. We will be taking stock of all those numbers as well. And of course, we'll have all your stock-related queries answered by our expert on the show. If you have any queries, of course, send them in to us on our YouTube feed and we will have them addressed. But before we do all that, let's take a look at the top headlines at this hour. Wall Street ended mixed on Friday. S&P 500 and Nasdaq snapped a 4-day winning streak while Dow Jones booked a 5th straight day of gains. Better than expected inflation prints lifted the Treasury yields after 2 sessions of weakness. Asian markets trade largely lower ahead of the release. In fact, the release of Chinese GDP data is something that we saw missing. Expectations came in at 6.3% vis-a-vis expectations of 7.1%. And on the back of that, Asian markets largely mixed. In fact, Hong Kong will see a delayed start owing to a typhoon warning. China's, of course, as I mentioned, Q2 growth missed expectations. But, the GIFT Nifty is hinting at a muted start, but above that 19,600 mark for the Nifty. Among key earnings today, HDFC Bank likely to report its highest ever, highest year-on-year profit growth in 14 quarters, although net interest margin could decline from the IT pack. LTIMindtree expected to record flat revenue growth in the first quarter. Well, we also put the spotlight on stocks like Bandhan Bank, DMart and JustDial on the show. And the G20 finance ministers and central bank governors meeting chaired by FM Nirmala Sitharaman and RBI Governor Shaktikant Das gets underway today. Ahead of the meet, US Treasury Secretary Janet Yellen says India is the United States' biggest trading partner as it seeks to diversify from countries posing risks to the global supply chain. Well, on that note, let's bring on board our first guest for today, Nirav Karkera, who's the head research at Fisdom, joining in this morning. Good morning, Nirav. Good to have you on the show. Well, first of all, I want to talk to you about the kind of record run that we've seen on Dalal Street. Lots of investors who may have missed the bus on this rally may be left with a FOMO feeling. How would you advise them to approach the markets now?
So it is good morning. It's a fine week ahead of us. Like you said, it's a result heavy action-packed week. So far, Dalal Street has been highly euphoric with the benchmark indices recording lifetime highs. It is only natural for investors to have the feeling of FOMO at this point in time. However, one must understand that the biggest opportunities still lie ahead of us. Most of the run-up is ahead of us. Just because an index hit or recorded a lifetime high, it is in no way a commentary that it has peaked in any way. So there are pockets of opportunities. India is entering a secular expansionary phase. We can expect the earnings to only expand going forward from here. And the earnings expansion cycle has only just started. If we look at most of the facets, for example, the investment cycle, the credit cycle, it has only just started picking up. You see, the expansionary plans that most private industries are talking about are still in paper and yet to be implemented. So it's a longer road before all of these implementations happen and the earnings are realized out of it. If we look at India's positioning from a macroeconomic standpoint, it is very solidly positioned even while most advanced economies continue to struggle at this point in time. So while it is highly confidence inducing for the investors who have already been invested and are experiencing this lifetime high levels, I feel for newer investors, there still exists a lot of opportunities. One must understand that while prices have really gone up on the bourses, the earnings expansion has outpaced the price increase. So if you look at valuations from a relative valuation perspective, and especially when you adjust it for the context of growth that one is penciling in, you might realize that maybe the lifetime high doesn't really imply expensive market levels, at least not across the board. So right now there are immense number of opportunities available across the board. I'll not just talk about Nifty 50, but way beyond the bellwether pack as well. So investors trying to seek exposure to equity volatility now continues to be a great and fantastic time to build positions. Slightly cautious investors may do better by staggering their investments and continually deploying cash in a staggered manner and not going all in, because there could be intermittent volatility that could offer better entry points. But there, one thing is completely out of question, that is waiting out a cycle and awaiting a very deep correction. Obviously, unless something really out of the blue happens, one can expect markets to be, riding a secular trajectory towards growth.
All right, not the time to sit out. That's the message from Nirav. But Nirav, what about IT stocks? How would you approach this pocket, given the fact that everybody was expecting a couple of weak quarters for IT, given the global macro environment situation? But if you look at the first quarter numbers, most of them have reported, barring Infosys, most of them have held on to their guidance. Deal wins are strong, and employee costs seem to be in check now. And a lot of these stocks are trading very close to their long-term averages as well. Would you say this is the time to actually buy into IT stocks and wait for the long term?
Definitely. One thing I would say that, clearly IT is entering its last leg of downgrades, its last phase of downgrades, and most of the worst is already factored in. In fact, the prices of IT stocks also reflect the same. If you would look at the kind of investor reaction and you use share prices as a proxy, post results, you would see that while there was a lot of disappointment expected, the results that came out were slightly more heartening than what people were expecting. So, while the worst was factored in, it was slightly less than what was factored in that actually turned out and actually panned out. The order book is really strong. If you look at the total contract values, it is really strong for large IT corporations. If you see, mid-sized IT corporations are also gaining lost ground. At this point in time, I would say that the downtime has been very well utilized towards building capabilities and future-proofing the business. The same is reflected in the order book size and how IT companies have been able to have a stronger hold on their talent resources. For instance, you would see that the attritions are also at multi-quarter lows, and you would see that in one of the large IT companies, an important commentary was how a wage rate hike also impacted their margins by a tune of approximately 200 bips. This is, while in the short term, a pain point for investors. However, one must realize that this also speaks volumes about the kind of investment that these IT companies are making towards upskilling and retaining internal talent, which is a far more efficient way of building a larger talent pool. So IT companies are doing these things really well. I feel there's significant opportunity, and there could be surprises on the upside in the forthcoming quarters. So most of the tough times are already factored in. Most of the global slowdown is already factored in. Any sign of recovery in the advanced economies, any signs of recovery in the domestic economy, furthermore, will also boost the earnings potential of these IT companies.
Right. Lastly, I want to talk about DMart. It reported its numbers over the weekend. Margin pressure continues for this company. In fact, there is fair bit of weakness in the general merchandising and apparel segment for this company. Margins, of course, were a concern last quarter as well. And, if you look at, but on the brighter side, if you look at what the company has done over the last quarter, it has added just 3 stores. But even then, the revenue growth has been over 18%. So would you say that, the same store sales growth that means the same store sales growth seems to be improving for this company. So if somebody is invested in this stock, would you advise them to hold on for the long term, or would you say that, if there's any kind of rally coming in, use that to exit the counter? How would you approach this one?
So a few important highlights about the way DMart operates its business, right? So obviously, same-store sales have been picking up, but it still, remains a point of concern to a certain extent. One would expect the productivity to really, really kick off for it to cover up for the shortcomings that it is facing on the general merchandise and apparel front. The general merchandise and apparel segment is amongst the most margin accretive business segments for Avenue Supermarts, and these operate with really high operating margins. So any slump on these segments really translates into lowering margins at the bottom line level. However, one can expect these segments to continually remain under pressure. In fact, if you talk about apparels, there's a lot of competition from other players in the value apparel segment. To name a few, probably Zudio, Max, where they are growing and expanding at a rapid pace. One important thing to also acknowledge is that while it's a good thing that there has been marginal store increment and the top line has been expanding at a healthy pace, it is also important to understand that store expansion is also an important lever for DMart to ensure that it does not concede market share to other competitors, especially in the highly competitive apparel and general merchandise segment, where it has high operating margins. But there is also a greatly intensifying competitive landscape at this point in time. So one would expect Avenue Supermarts to give more, to offer more commentary and insight into what are the plans in with respect to store expansion and the productivity plan on each of these stores. So while the productivity has obviously gone up sequentially, one could really be on the watch out for higher numbers on higher sales per square feet metrics to be reported. For investors already having exposure, this remains a very good play on the FMCG segment, on the retail segment, consumer segment. The stock continues to reflect the earning potential to a fair degree. There is very limited scope for surprises on the upside or downside. So depending on how one wants to play the segment and how one feels about Avenue Supermarts going ahead, one can take a call whether to stick onto it or move ahead. But for now, we believe there will be very limited surprises on either side and a flattish sort of a growth trajectory going ahead.
Right, that's the view on DMart. Then very limited surprises expected on the upside and the downside. With that, Nirav, thanks a lot for taking out time and joining in this morning. I wish we could have a longer conversation, but let's keep it for some other day then. Well, with that, let me also bring on board our next guest for today. Rajesh Palviya of Axis Securities is joining in. Good morning, Rajesh. Well, after being stuck in that 19,500 mark, in fact, around that 19,500 mark, we managed to hit a fresh high. In fact, we clocked in a record close on the Nifty on Friday. But, on the upside, what are the kind of resistance level you'll be watching out for on the Nifty?
Morning, Nandita. So clearly, we have seen a clear breakout on the weekly basis, and looking at the close of previous week, we are confident that this rally can extend further higher, and possibly Nifty can scale up to the level of 19,700, 19,800 in the continuation of this uptrend. If you look at the overall market trend, that has improved significantly. Fund buying is continuously happening in the market. Market sentiment is on the bullish side. Sectoral rotation is happening. Put writers are aggressive at higher strikes, so which all odds are in favor of to remain on the bullish side, and we expect that in the current week 19,700, 19,800 could be the possible target for Nifty. One should remain on the long side. Any minor dip should be used as a buying opportunity. Keep your stop losses at around 19,400 to hold your long position. The same way, Bank Nifty is almost trading near to 45,000 level. If we able to cross those level, then Bank Nifty may also exhibit further round of short covering action, and possibly Bank Nifty can scale up to the level of 45,500 to 45,600 in the current week. So Bank Nifty is also looking bullish. Keep your stop loss at around 44,650 to hold your long position on the banking stocks as well as in the Bank Nifty.
All right, those are the levels to watch out for on the Nifty and Bank Nifty. Since we're talking about the Bank Nifty, let's talk about two stocks in focus. Firstly, HDFC Bank will be reporting its first quarter numbers today. Profit likely to jump 25% or thereabouts on a YY basis. I'm talking about the standalone bank. And, NII expected to rise somewhere around 21%. Key to watch, of course, will be profit growth. In fact, it could be the best in 14 quarters, and margins also likely to remain stable. If you look at the commentary, of course, the integration plan is something, commentary around the integration plan is something that the street will be watching out for. So, one, what's your thought on HDFC Bank before it reports earnings? And secondly, Bandhan Bank. reported a fairly weak set of numbers. In fact, Street has also cut EPS estimates. In fact, if you look at Nomura, it has cut the FY24, FY26 EPS estimates by anywhere around 11 to 14%. Jefferies has also cut target price. In fact, it believes that loan growth and NII growth could look at improving from the second quarter, and CLSA also believes that the improvement in asset quality would be rather gradual, and it has also revised FY24, FY26 earnings estimate downwards by 3 to 6%. So two banks, HDFC Bank ahead of earnings, and secondly Bandhan Bank after a weakish set of numbers. What would you advise investors to do on these two stocks?
So HDFC Bank is now trading near to its important support area of 50-day as well as 100-day moving average, which is almost trading at closer to those moving averages. So looking at the overall long-term setup, we are bullish on the HDFC Bank. Yes, some profit taking was there in the near term, but still look at the short to medium term setup. It's available at very attractive price point. So our advice is to remain on the long side, as overall setup for the stock is on the bullish side, and we expect once the stock crosses above 1670, then this can extend, this can move further higher towards 1720 to 1740 on the higher side. So our view is on the bullish side for HDFC Bank. Keep your stop loss at 1615. Bandhan Bank is still on the weak side. If we look at the near-term, short-term, medium-term setup, the stock is in downtrend, and if we look at the daily as well as weekly chart, the stock is traveling in down-sloping channel, which clearly indicates that whatever pullbacks we are seeing in the stock is meeting to the supply pressure on the high side. The stock is trading below to all its short-term, long-term moving averages. So till stock not crosses about 240 zone, it will remain under weak zone only. So in pullback, our advice is to exit. Even on the downside, if it breaks below 210 level, then possibly further round of selling pressure we can see in the stock prices. So our advice is to avoid at this juncture to buy. Even if it comes near to 230-35, one can go short also with stop loss of 245.
All right. In fact, we had a query from Sapna Singh on HDFC Bank. Hope that answers your query. I also want to talk about one stock that has come under SEBI scanner, Angel One. It had reported its first quarter earnings. Profit saw a good 20% growth on a YY basis. But, Angel One is now prohibited by the SEBI from adding any new authorized persons for 6 months. And the existing operations of all authorized personnel have come under probe. If you look at the chart of Angel One, I think I think on Friday's session it lost somewhere around 2% or thereabouts, and over the last 5 sessions it's up somewhere around 3% or thereabouts. Do you think this bit of news comes as a big setback for the company, and the stock could head lower on the charts from here on?
So after a strong rally since last 2 weeks, stock is struggling to cross its 1740, 1750 resistance area. Looking at the last 2 week candlestick formation, it clearly indicates that there is a indecisiveness in terms of price behavior. Looking at the near-term, short-term setup, we expect if the stock breaks below 1680 level, then possibly we can see furthermore, selling pressure to come in the stock prices, and possibly stock can go down towards 1600, even 1580 level on the downside. So one should avoid at this juncture on the buying side. Rather, one can book profit if it breaks below 1680 level, then possibly another 100 rupees cut we can see in the near-term basis. On the higher side, 1760, 1770 are the key resistance area. Until the stock not crosses those levels, it may remain under pressure for some time, and possibly some pressure we can see in the prices in the near-term basis.
All right, book profits maybe is the call, and avoid buying into an Angel One. Stock of the day today for me would be LTIMindtree, given the fact that it will be reporting its first quarter earnings. It had recently joined the elite Nifty 50 club. In fact, in Friday's session, it hit a fresh 52-week high. Of course, all the IT stocks were high flyers in Friday's session. But given the fact that, LTIMindtree is expected to report a muted set of numbers on a quarter-on-quarter basis, of course, given the fact that, there is a slowdown in tech spending globally, then that could impact the first quarter numbers. But if you look at what the brokerages are expecting, they believe, JM Financial rather believes that absence of wage hike may in fact aid EBIT margins for the company. Profit growth for this company is likely to be better than peers. How much of more of an upside do you see on the charts for LTIMindtree, given the fact that it has crossed that 5,000 mark and is now perched at 52-week highs?
So most of the mid-cap IT stocks have done well, especially in last 2-3 trading session, and we have seen a significant recovery in IT as well as the mid-cap IT stocks. Looking at the setup for LTIMindtree, we are bullish. We are holding bullish view as the stock has taken the support from its important support area of 200-day, 100-day moving average, and we have seen a strong buying action in last 2 trading sessions. Looking at the near-term setup, yes, one can hold the position with stop loss of 5,000, and on the high side we are projecting target of 5250 to 5300 in the continuation of this pullback which we are seeing since last 2 trading session. So hold your position with stop loss of 5,000. Target is 5250, 5300.
All right, those are the levels to watch out for on LTIMindtree. Let's take up some queries that are trickling in on our feed. Sai Reddy wants to know about Aarti Industries. He says that Aarti Industries is now down 50%. He wants to know your thoughts on the medium term and long term views on the stock. So
stock is bearish across all time frame, be it monthly, weekly, and daily. Continuously, we are seeing that series of lower top, lower bottom formation on the daily, weekly time frame, which clearly indicates that trend is on the downside. Underperformance is still there from the stock. There is no significant recovery we have witnessed in the stock prices in last 3-4 months. Looking at the overall setup, we expect that if it's continuously trade below 500 level, then there is no ray of hope as such in terms of recovery in the prices. So 500 is the key resistance area for short to medium term basis. Till stock not crosses those level, there won't be any significant recovery we can see in the prices. On the downside, 530, 430 is the immediate support area. If it breaks below those level, then furthermore selling pressure we can see in the near term to short term basis. So at this juncture, our advice is don't average at this prices also, because overall structure is on the weak side. Wait for 500 level to cross, then again one should review the stock to average out or to go long in this stock.
All right, avoid averaging at the current juncture. That's the view. Hope that answers your query. Let's take up a query on Olectra Green Tech. This one is coming in from Hemant Jaju. Well, of course, this stock has been on a tear over the last 1 month. It has jumped 40% or thereabouts on the back of order wins. Would you advise investors to look at dips, or do you think it's time to go all in, given the fact that the stock continues to outperform on a daily basis?
So this stock is directly beneficiary for EV side of automobile sector, and we have seen a very strong run up in the stock prices across all time frames. Stock is in bullish zone, and looking at the long term setup, we expect that if you get any opportunity to buy the stock in any dip towards 1300, 1270 is a good opportunity again to re-enter in the stock, as the stock has already run up 40% in the current week. So wait for some pull-off action towards 1300 to again re-enter in the stock prices. And looking at the long-term setup, we expect that this rally can extend further higher towards 1500, 1600 zone also. So overall, stock is in bullish trend. Buy on dips is the strategy.
All right, buy on dips is a strategy for Olectra. Hope that answers your query. Let me also take up one last query from Mohit Anand Bhatia. Wants to know your thoughts on FACT, whether it's a good time to enter. FACT, of course, along with other fertilizer stocks, has been rallying over the last 5 sessions. We've seen the stock gain somewhere around 10% or thereabouts. I mean, is it a breakout stock, and can we expect higher highs on this counter?
Yeah, clearly there is a breakout on the weekly as well as on the monthly time frame, and stock is very well holding its breakout on the monthly chart since last 2 months. Looking at the breakout on the monthly chart, we expect that if stocks continuously hold over 460, 470 zone, then possibly in the short term, this stock can extend its gain towards 540 through 560 also. So hold your long position, keep your stop losses, trailing stop losses at around 470.
All right, that's the view. But let me ask you about one last stock that I want to speak to you about. It's on JustDial. Numbers have been fairly strong. It has, swung back to profit vis-a-vis a loss of 48 crore in the same quarter last year. Revenues are up 33%. EBITDA, of course, pretty strong, over 36 crore or thereabouts. And margins have also jumped multifold to nearly 15% on a YY basis. Stock was up 7% on Friday. Over the last 5 days, up 13%. Do you see more upside, or do you think it will come under a fair bit of profit booking today?
So on the weekly time frame, stock has managed to give breakout of its last 4-week consolidation zone. Looking at the overall setup for short to medium term perspective, also stock is now forming a rounding bottom formation on the weekly chart, which clearly indicates that this rally can extend further higher. 940 to 970 could be the possible target in the short to medium term basis. So hold your position with stop loss of 800. Upside target is 940, 970.
All right, that's the view on JustDial. I think we're running out of time. Rajesh, what are you recommending for our viewers this morning?
So first stock is from metal space. So Jindal Steel and Power is looking very attractive. 660 is the target. One can buy with stop loss of 628. Another stock is from Midcap IT, that is Birlasoft. Very strong price action in the previous session. Looking at the breakout, we expect that this rally can extend further higher. 395 is the target. Keep stop loss of 372. And the third stock is from Auto Ancillary, that is Balakrishna Industry. After consolidation, now stock is given breakout in the last trading session on the daily chart. Looking at the breakout, we expect 2500 is the near-term target, and keep your stop loss at around 2400.
All right, those are the stock picks rather coming in from Rajesh. With that, Rajesh, thanks a lot for taking our time and joining in this morning, and of course also addressing all of your queries this morning. But it's a rainy day here in Mumbai, and it's raining IPOs on Dalal Street, given the fact there's another new IPO that will be hitting the streets today. Netweb Tech issue opens today, and it's open till about 17 July. Issue price band is somewhere around 475 to 500 rupees per share, and the size is somewhere around 630 crore rupees. It's a fresh issue of 206 crore rupees and an OFS of 8.5 million shares. Promoter shareholding will be coming down from to 75% from 95%. So that's one IPO to watch out for. But with that, we're completely timed out on this edition of Morning Trade from the entire team. Thanks a lot for watching. But don't go anywhere, because coming up next is Opening Bell. Stay tuned.